Hey guys, hello and welcome to the 11th episode of the Markets at a Glance series. My name is Rufas Kamau, Markets Analyst with FX Pesa. So on today's presentation, as usual, we basically cover what's happening in the markets, the most important data or information that is available in the markets, try to digest this information into actionable intel. And once we get this through, then hopefully we get to create value for everyone. So before we proceed, I'd like to do a mic test. So if you can hear me clearly, kindly type hi on the live comment section. I think this time we need to change. We don't have to do hi every time. Let's do Merry Christmas. It's almost there. All right, guys. So let's get this started. So there's quite a lot that has been happening in the markets this month. Last week was the craziest. This is when we had a series of rate hikes from major central banks. So the Federal Reserve Bank of the US hiked rates by 50 basis points. Bank of England, 50 basis points. The ECB, or the European Central Bank, did another 50 basis points. The Swiss National Bank did another 50 basis points. So all these things were happening at the same week. We had a lot of volatility happening last week. So at the same time, we had inflation data. We saw inflation slowing down in the Eurozone, slowing down in the UK, the US, as well as other major economies. So the only one exemption where things are not going in a similar manner, or there is no correlation with other central banks, is the case of the Bank of Japan. So what we're experiencing in Japan is special and also different. One key thing to notice is that interest rates have remained at a negative rate. That is negative 0.1% for the last couple of years. And this has made a big divergence between other central banks, creating trading opportunities for traders that take their fundamentals seriously. So what we are experiencing with the Bank of Japan is an area where inflation is consistently rising. They are looking forward to it, while other central banks are basically complaining and looking to solve the issue of inflation. The Central Bank of Japan is basically looking to build inflation towards the positive side. So one of the reasons this has been happening is that the Bank of Japan has been fighting deflation for the last 10 years. So a decade-long period fighting deflation, or basically negative inflation. So what has been happening is that the Japanese yen has been gaining value over time. So they've been fighting that to make sure that at some point it reaches a target of 2% losing value over time. So this is what has been happening with the Bank of Japan. So hello guys and welcome to the session. Hello Peter, hello Aloysius, hello Eric. Thank you guys for joining the session. Let's keep this going. So now that we understand that there has been a big divergence between the Bank of Japan and other central banks, it's time now we look at the charts and look at the major currency pair affecting the Japanese yen, and this is the USD JPY currency pair. So since the beginning of the year, right here, the intersection between the red and the maroon line, you can see that this is where the exchange rate was at the beginning of this year. And this is 115.058. So since then, we saw the strong acceleration where the dollar was basically gaining against the Japanese yen. So there was a very strong move that lasted a couple of months. I'm talking about 8 months. From here, from February, March, April, May, July, August, September, the US dollar was just gaining against the Japanese yen. So in this period, we saw the US hike interest rates. And this interest rates hike started roughly in March. So investors always trade before the Fed decision. So you can see the rise started in February before the eventual rate hike in March. So in February, the interest rates in the US was 0.25%. So we saw a 0.5% hike, followed by a sequence of 4 consecutive rate hikes that were quite big, 0.75% each. And then in the last meeting, that is December meeting, we saw another rate hike of 50 basis points, which eventually took the interest rates in the US from 0.25% all the way up to 4.5%. So during this period, the Bank of Japan maintained interest rates at negative 0.1%, and this huge policy divergence basically created this difference in the exchange rate. So that's why it's very important to follow the central banks and the decisions they are making, since they influence the exchange rates of the currencies. So when you understand this, then you're able to establish a bias, and in this case, you should have been mostly on the bullish positions in order to make maximum benefit from this movement. So then, since this particular period, what we saw is that the Bank of Japan started intervening in the currency market. And by intervening, basically means buying more Japanese yen and effectively strengthening the yen and pushing the prices back down. So since this particular period, we have seen consistent movement in the Japanese yen strengthening back against the US dollar, eventually erasing like 50% of the gains that we made throughout the year. So if you are to measure from the beginning of the year, the highest level, we saw an acceleration of about 31.95%, or rather almost 32%. But then if you look at the pullback in the current price level right here, we are up 15% of the year. This basically means that we have erased half of the gains. So what we are seeing with policy right now is that the US is shifting policy, and also the Bank of Japan is shifting policy. So for the Fed, it has maintained a very strong stance that is going to continue hiking interest rates, albeit at a smaller pace, until the rate is restrictive enough to push inflation back down towards the 2% level. So we know that inflation in the US has been on the rise for the better part of the year, having peaked somewhere around June, where we had 9.1% inflation in the US. So since then, the Fed accelerated the rate hikes, and we are already starting to enjoy this effect where the inflation in the US is now cooling down, and at the same time, the dollar is also cooling down. So with these interest rates going up and up, now inflation is going down. So since the 9.1% in June, we have seen the inflation rate slow down consistently month over month up to the current month, where in the previous reading, we saw 7.1%. However, 7.1% is still significantly high. So the Fed has made its point that it's going to continue making smaller rate hikes until the rate is restrictive enough to push the dollar, to push the inflation back down towards the 2% rate. So with this in mind, we expect at some level, with this having some strong dollar against other currencies. But then it's also important to understand that the Bank of Japan is also shifting its policies. So in today's meeting, we had the Bank of Japan press conference. They decided to maintain interest rates at negative 0.1%. So nothing has changed from the interest rate side. But then there's a couple of stuff that has happened in today's meeting early in the morning that has surprised a lot of analysts and investors in the market and caused a big spike in JPY currency pairs. So one of the things that we saw is that the limits for the yield curve control program were adjusted from 0.25%, and this limit is around zero. So there's the upper side and the lower side. So positive 0.25% and negative 0.25%, which are the allowed limits for the interest rates in the Bank of Japan. So the Bank of Japan has been practicing what we call yield curve control, or basically controlling the yield on the 10-year bonds or Japanese government bonds. And this limit started at 0.0%. Then it was moved to 0.25%. So in today's meeting, they adjusted this by doubling it to 0.5%. So now the interest rate or the interest returns from the Bank of Japan bonds, that is 10-year bonds, can now vary between negative 0.50% and positive 0.50%. So with this in mind, we know that there is more leeway for the bonds to move around, which means that the Bank of Japan doesn't have to print as much currency as it would otherwise be forced to if the limit was much smaller. So with this in mind, now we're expecting that the Bank of Japan will not be printing as much currency, and this basically means that there's some room for the Japanese yen to start strengthening. So it has already been strengthening for the last couple of months. We have already seen in the chart. So since the high that we saw right here in October, November, the Japanese yen was basically strengthening against the US dollar. And this month, it's also strengthening. So we had some form of range, sideways movement in the last 2 weeks. But since this morning's announcement, we have seen the Japanese yen strengthen quite a big move here against the US dollar. So just to be precise, we had over 3% move. So from the announcement right here all the way to the bottom here, we are looking at 3.89%. This is a big shift here in our price level. So I'm sorry, I just lost my power, but we continue anyway. So with this big drop, it basically means that there's more expectation that the Japanese yen will continue strengthening against the dollar. So while the Fed is slowing down the rate hikes, at some point, we'll be expecting the Bank of Japan to now start implementing rate hikes. So going forward, the Bank of Japan also said that it would increase its bond purchase program to 9 trillion yen. And this is somewhere around $67.5 billion per month. So this is against our previous number of 7.3 trillion yen. So with the Bank of Japan printing even more money, at the same time, we'll be expecting the Japanese yen to start strengthening, weakening at some point, since the currency in circulation is being increased. So also key thing to notice is that the Bank of Japan owns over 50% of the available government bonds, that is the 10-year bonds. So just to put this in perspective, way back in 2021, when the US was doing quantitative easing, the peak limit of the QE infinity was around 120 billion per month. So the fact that the Bank of Japan is pumping 67.5 billion per month in the economy, this basically means that we're expecting a much stronger growth in the Japanese economy, and this is bound to weaken the Japanese yen further. So despite what you are seeing in the charts here, the Japanese yen strengthening against the dollar, as long as the Fed continues hiking interest rates and keeping them high compared to the Bank of Japan, then the overall trend still remains higher. So in this case, there's a good chance we'll be seeing a reversal in this move. And one key thing to consider is this particular trend line, where there's a good chance that the market could continue, let's say, for the rest of the week, downwards, get to the lower trend line, and then bounce from there. So a nice area to look for trades in the opposite direction might be 159.5. And if the market happens to show signs of reversal, then it will back upwards. So that seems like a very interesting case to build a position upon that. Of course, you have to do more research, understand what's happening between the two central banks before you make an investing decision. So another key thing to mention is that in today's presentation, as well as all the YouTube series that we are doing, we do not offer investment advice. This is purely educational to help you understand these concepts, narrow down to these ideas. Sometimes I make projections that might be right, sometimes they are wrong. So you have to do your own analysis and your own decision before deciding to execute a trade in the markets. So now that this is clear, we can move on to the next point. Today we don't have a lot of trading ideas. The economic calendar is very quiet. So we'll be moving on to the next point before we end the presentation. If you have any questions, comments, or additions to the session, feel free to type those questions, the comments, the additions, and they will be much welcome in this session. So, hello, Peter. Hello, Simon. Hello, Trapscad. We have Kimani, David, and Anne. Thank you, guys. Thank you for joining the session. Let's keep this going. So now, now it's back. Thank God, this is good. Now it's back out. Weird. So let's keep on going. So on the other hand, we have what we call the Santa Claus rally. And this is pretty much important because it's almost often the last trade of the year. So this refers to the last five trading days of the year, as well as the first trading days in January. So immediately after Christmas, there's usually 5 trading days between Christmas and New Year. And even from New Year, we have 2 more days in addition to January. So these 7 trading days are often associated with what we call a Santa Claus rally. Sometimes it's called the calendar effect. So what we normally experience, and this is something that has held true since the 1950s, the S&P 500, which is basically the US stock market index, has been going up an average of 1.3% since 1950 up to 2022. And this is big news since it's basically a statistic. It's something that people have been following. Something that people have been acting on and making money each and every Christmas. So it's almost like a parting gift that keeps on giving each and every year. So when I mentioned that this has been going up 1.3% on average, it basically means that not all the years are positive. There are some years where the S&P 500 goes down during this particular period, and there are some years when the S&P 500 goes up during this period. So when you look at the statistic from way back in the 1950s, you will notice that 79% of those years, the price of the S&P 500 has been going up compared to going downwards. So this is almost 80%, meaning that 8 years in every 10 years, the S&P 500 is going up during that 7-day period, and only 2 is when the S&P 500 is going downwards. So there is still a risk that the S&P 500 could go down during this particular period, but if statistics play out as expected, then there's a good chance that the S&P 500 will go up during that period, and the expected outcome is around 1.3%, which is the average over the last 72 years. So the very foundations of logic and fundamentals are put to the test by the calendar effects, yet they still exist and demand our attention. So we are not sure what will happen in this particular Santa Claus rally, but if it happens, then it's important that you understand these and you take actionable trade based on available intel. So we know that this year has not been very good for the S&P 500. It has been on a bear market since the beginning of the year. So far, it's down 20.11% since the beginning of the year. So we know that most other stock markets have also been in a bear market. So for stocks, it hasn't been an easy journey, especially when you consider the interest rates. So after hitting the September low, and that is about 2 months ago, that was around $34.89 per share of the S&P 500. We saw the market rally for 2 consecutive months. So last month in October and November is when we saw the S&P 500 strike a very strong rally up to 41.02 before dropping in the last 2 consecutive weeks. So let me illustrate this so that you can get the idea clearly. So SP 500 chart, this is what we are looking at. So this is a 2 months continuous rally, or basically 8 weeks. And once the market got to the upper trend line, and this upper trend line has held through for the better part of the year. So this is the S&P 500 peak. So it was an all-time high at the very first week of January last year. So since then, you can see the bear market started there, market went down and then up, down, up, down, up, down, up. And this was the price 2 weeks ago. So during this period, you will notice that the market was rallying for 2 consecutive months and got to this particular trend line here, found resistance, and then went back down. Didn't quite break the lower trend line here. It went back up to retest the resistance here. And then during the news last week, we saw the market spike all the way up and then move in the opposite direction, break the trend line and continue pushing down lower. So far, we are seeing a very strong bearish momentum in the S&P 500, and this is just ignoring the idea of the Santa Claus rally. So technically, the market is indicating that the price is going back downwards. So now you can see there was a very strong support level here, was broken last week. The market proceeded to go down, and now we are holding at a certain level that we found as a resistance in this particular week in October. So clearly, this was the highest price that we experienced in October before the market broke here towards the beginning of November. So now the price is playing around this area here. And we know that the Santa Claus rally only has 3 days. So today is Tuesday. So we have Wednesday, Thursday, and Friday. Before we get to the weekend, market, of course, will be closed. Then when the market opens back after Christmas, then we'll be looking at potentially higher or even lower prices in the S&P 500 index. So one key thing to notice is that there's important price levels. One of them is 39.06, which was clearly acting as the resistance here. So the market could rally all the way back to the 39.06 and even higher. And also, if the bearish momentum after this breakout of the bullish channel, so remember, this trend lines channel, market, if the bearish trend continues, then this particular low that we saw in November would be very instrumental in trading the S&P 500. So the price would literally drop to that 700, and it's something you can take advantage of. But then, if on the flip side there is a Santa Claus rally, then that's 900 might be a nice target. On even 980 or even higher. So that's one key thing. Consistently aware about, just focus on the charts, we'll see where they are headed, and then look for the trading opportunity. So besides these, all other markets seems to be trading sideways. So we can say this is a trend. Once the market is trending upwards or downwards, it's majorly some form of sideways momentum. So if you US oil, you go to the 4-hour chart, then you look at price action here. It has been a bearish momentum, so you can all see this. So that's our upper trend line. If you look at our lower trend line, clearly following this particular path. So swings are quite big, going up, down, up, and now we are on an upswing. So there's a good chance we'll be retesting this area before the market maybe decides to break or even drop further downwards. So the high of last week seems to be very instrumental in the current price action, where the US oil would literally hit $77 per barrel. And if there's a chance, or if the bears come in, then we see the prices move back downwards. However, if bullish momentum continues, then we break, get to the previous high, and this is around $82 per barrel. So this might be something you might be interested in. So the key determinant price level seems to be last week's high, around 77.75. If price breaks here, we go up. If it bounces, then we go back downwards. So for the US dollar, that is the dollar index, as you can see, for this week has been quite a number of confusing signals, going down and then up and then down, up, all the way down, up, down, and then now we're moving upwards. So it's not quite clear where the dollar index is headed. So following the news in the early morning, where we saw the Bank of Japan make decisions that strengthen the yen, on one side, we saw the yen across all major pairs, including our yen, strengthen. But then, if you're looking at the dollar index here, dollar has been regaining strength over the last 2 hours. So there's a good chance we could be seeing the dollar regain strength and continue to dominate against other markets. So Audi USD are the same. You can see the dollar is very strong against the Australian dollar. A dollar very strong against the pound and also very strong against the euro. So as you can see, we bounced from the upper trend line on the euro USD. We're headed further down. So the support level is close by around 1.05686. So there's a good chance that if the dollar keeps strengthening, we'll get to this level, 1.05686. For pound USD, we are looking at a potential break of this particular consolidation here. So the market was largely moving sideways. So if we experience a break, very nice to trade this particular break. So I'm looking at a market that has been oscillating between these two trend lines. So if it manages to bounce from here, then we trade back up towards the upper trend line. But then there's a good potential that if the dollar remains strong, then we'll see some further downside. And in this case, a break of this level was a previous low that we experienced some time back on this particular flag here. So this would still be in the books. So just a moment, just want to look at the price very well. So this is 1.189, or basically 1.19. So we could see the pound USD dropping all the way down to 1.19. We already have a crossover here on the moving averages. So the crossover is on the moving average of 100 versus the moving average of 200. So with this crossover, it indicates a change of the trend. So the last time there was a crossover between the blue and red line, there was a very strong bullish momentum. And now that it has happened, there's a good chance we'll be seeing the price of pound USD drop further downwards. So that is pegged on whether or not we'll be having a strong dollar. So for Audi USD, you can see on the 4-hour chart, we had this particular consolidation that looked like a wedge, and then the market broke towards the lower side, tested, and is now moving further downwards. So the base of the wedge here is 0.65854, which is the expectation that the price might continue going downwards until it gets to this level. So you just have to be patient and then look for the right opportunities in this particular market. So that being mentioned, we are approaching the end of the session. I'm just checking out to see if there's any questions, respond, and then we end the presentation. So does time frame matters in trading? Time frame matters when you're doing your analysis, but it doesn't necessarily affect price. So I want you to think of the time frame as the bundle upon which you process price. So when you look at candlesticks are very simple. They are basically a summary of price action for a particular period. So let's say you had a person monitoring the market for you and reporting to you what the market is doing. So you can get a very simple and direct summary. Let's say for a daily candlestick, the person working for you, they will tell you the market opened here, went to a high of this place, a low of this place, and a close of this place. That would be a very simple summary of what happened within that day. But then if you want a more detailed summary, then the person can take smaller bundles. They can tell you in the first 4 hours of the market opened here, went to a high of this point, a low of this point, and crossed here. Then the next 4 hours, market opened, went to a high, low, crossed here. But it's still the same price, whether you're using the daily, 4 hour, 1 hour, and so on. So you get a little bit more detail on a lower time frame, and these can help you make intraday decisions when you're using smaller time frames compared to higher time frames. But the price is still the same. So if you predict the market will go up and you trade on a daily chart versus a 1 minute chart, the trade is still the same. So thank you, Dantec. Good work. Thanks. Any views on USD? Do you expect it to continue down or up? What about gold? Okay, I think these are the last two questions I'll be answering. So for the US dollar, the Fed was very clear. It's going to remain hawkish. It's going to continue hiking interest rates, albeit at a smaller pace, and then keep them high for the rest of the year. That is for the rest of 2023. And that basically implies that the dollar could get really strong. So if the dollar gets strong against other currencies, then you'll see the overall trends that we had early in the year continue to dominate the markets. So that's my expectation for the US dollar. So as for gold, we had a very strong momentum earlier. So you can see from the 4-hour chart, this is what we are seeing. Gold making a very strong case here on Friday last week. Yesterday moving sideways, slightly bearish, and then today a very strong momentum upwards. But then go to this resistance, you can already see that bears are attempting to enter this market. So I'm following this particular resistance here, and now gold has gotten to the same level, and you can see the immediate impact where the sellers are entering the market. So since then, we are seeing potential, but the market may have found resistance here, and we could see the market moving further downwards, especially during the New York session. So these are key things to consider, that we could be seeing the price of gold drop further downwards towards the 1765, especially considering that the dollar has resumed strength. In the last 2 hours, this is how the dollar index is now moving towards the upper side against other currencies. So thank you very much, guys. Thank you for your time and also your participation. I always enjoy presenting these sessions with you guys and also interacting with you. So the next session of the Markets at a Glance series will be right after Christmas. So it's in order to tell you Merry Christmas and enjoy your holidays.